Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Brzeski, and today we'll be speaking with Chris Fraley, Chief Investment Officer of RealtyMogul. We'll be discussing real estate investment across property types throughout the United States. So, Chris, thank you for joining us today. I'm looking forward to speaking with you.
Excellent. Thank you for inviting me.
So why don't we start with your personal background? Can you talk about how you got into the field you're in and your career path to this point?
Sure. I started my career in affordable housing in New York City. I was at the Department of Housing Preservation and Development, and then I went back, got my MBA, and then went straight into a real estate private equity fund called Arixa Capital, and I was there for about 14 years.
Tell us about where you are now. Talk about RealtyMogul and what you do there.
Well, RealtyMogul is a fintech company. We raise capital on behalf of real estate operators, and I'm the chief investment officer.
You mentioned that RealtyMogul is a fintech company. What makes it a fintech company as opposed to just a real estate investment syndication company?
Almost everything we do is online. Someone can, everything from marketing a deal, the delivery, we send out lots of emails, about 10 million a year. And based upon that email, people can pledge an investment into a individual asset. And it's the whole process is online. You really don't even need to speak to a human being.
Interesting. Do the investors need to be accredited investors in order to participate in your investments?
For the individual private placements, yes. For the REITs, we do accept non-accredited investors in the REITs.
So it sounds like there are two different areas of investment that we can talk about. One is the individual properties where your investors they own a portion of the property alongside the other investors, I guess. Let's start with that. What are some of the types of properties that you like to buy?
About 65% of what we do are value-add multifamily and secondary and tertiary markets. We also do development, and we'll do office, industrial, retail. We do not do hotels. And every now and then we'll do something unique. Last fall, we launched a cannabis REIT, which was very successful, and they've recently IPO'd. So pretty broad offering.
So you launched a REIT that is now public?
It recently went public, yes.
So the multifamily area, why is that of interest to you? Why do you focus on that?
I think it resonates well with our investors. It tends to be steady cash flow with some upside. Also, one of the challenges of syndicated capital is it's fairly difficult to do capital calls. For example, with office and retail and industrial, often those cash flows are fairly lumpy and not always suited for individual syndicated investors.
So you do both existing properties and also ground up development in some cases. What percentage of the projects would you say are ground up development?
We actually just started doing development about 18 months ago, so we're fairly new to that market. I would say about maybe 25 to 30% of our originations over the last 18 months have been development.
When investors participate in one of these syndications, what can they expect in terms of returns, the cash flow? How do you outline what they're trying to get, and how do they choose which investment is right for them?
We always post a projection of IRR and cash on cash that the sponsor provides, and we do our own secondary vetting of their underwriting. Most value-add multifamily transactions are usually about a 15% IRR in secondary and tertiary markets, and these are net returns to investors. If it's in a prime market, if it's a fairly newer product, those returns might be a little bit lower. And also, we typically, or our sponsors typically underwrite, 3 to 5 year holds. Often if the hold period is longer, the IRR might be a little bit lower as well.
So you mentioned your sponsors. So there's a local operator who is found the project and is sort of running the project. Are they typically investing as well?
Yes, we have about 75 operating partners who have gone through our system. We require, usually it's about 10% of the co-invest. We like that to be net of any acquisition fees that they receive. But regardless of the size, we do require a minimum of 250,000. So even if it's a small deal, we in the percentage, the 10% might be lower than that. We still require a minimum 250,000.
And when we were talking before, you mentioned that sometimes you are investing a smaller portion of the total in a project. So you and all of your investors are minority of the total. And sometimes it sounds like you're the great majority of the total.
Yeah, we can be 90% of a $15 million transaction, or we can be 20% of a $170 million transaction. Our minimums are 3 million, and the largest raise we've done to date is close to 15 million.
What have you found that your investors like the best?
They love Texas. It's a tax-free state. Those transactions seem to do very well, and they love cash flow. They love deals where they can expect to receive some current cash flow along with a little bit of upside.
And you mentioned the target return is in the double digits. That sounds high compared to the types of returns that are available elsewhere in the market. So how are your sponsors able to generate those types of returns?
Well, typically, if you're acquiring an asset that has maybe on average about 7% cash on cash return, and you're investing some significant capital into the project, usually our upgrades involve renovating the kitchens and the bathrooms, maybe some exterior or landscaping to improve the overall quality. And if you bump up the net operating income and sell in a fairly short period of time, that typically gets you to the mid-teens return on a value-add multifamily property.
And is it hard to find these types of projects, or are there lots of them out there?
We've been extremely lucky with this low interest rate environment. We've seen a lot of really great opportunities, a lot of demand from sponsors to put deals on our platform, especially over the last year. There's not a lot of capital out there that can write a $5 to $10 million check. If you go above $10 million, there are a lot of large private equity funds that can fund that. If it's less than 5, a lot of sponsors can kind of go to their country club and raise it amongst their friends. But the mid market can be very challenging to raise that, especially in the required time frame of a typical real estate transaction.
So it sounds like if you're raising, let's say, $7 or $8 million for a project, you put it out there to your investors, and then they give an indication over the course of, I guess, a few weeks whether they want to do it, and then you don't close until you've raised all the money that's needed. And if you don't raise all the money that's needed, then people don't get the chance to invest, I assume. Is that accurate?
To some extent. We're very fortunate in that we have a balance sheet that we can provide bridge capital. So if it's really just a matter of timing, if we're confident that the capital will ultimately come in, we have no problem bridging the capital to the sponsor.
I see. So sometimes you'll put in what's needed, and then as investors subscribe over time, you'll take your capital back and then use that next time.
Right, exactly. Although for for probably the last 12 months, we've only used that facility. I think we've used it once. So usually the capital, I mean, investors get in the capital pretty quickly. Um, we launched the deal a week ago Friday. We sent the email out to our accredited investor base. We opened for funding last Friday, and over the weekend, about $4 million came in that was actually funded. So it happens pretty quickly. I think sometimes, on smaller raises, investors are concerned they're going to miss out because it's really, you can pledge, but it's really on a first come first served basis. So, it's not uncommon for the syndications to fill up and there be waiting lists.
And what type of property was that most recent one, if I may ask?
Sure, it was a value add multifamily in a little north of Orlando.
Where do you think this fits in an investor's portfolio? Is it sort of comparable to anything else in their portfolio? It sounds like it's sort of like an equity investment, but instead of being in the public stock market or a REIT, a public REIT, it's a private investment. Is that right?
Yeah. So one thing folks need to be aware of is that it's not liquid. Unlike a stock, there's no liquidity for the investment. So, I think sponsors are pretty good about, exiting when they say they're going to exit. In many cases, we'll have majority control rights and we can force an exit if we feel like the sponsor's not selling when they said they were going to sell. But that is something that folks should be aware of, that it is an illiquid investment.
So in some ways, this would be similar to the kinds of investments that many people might hear about through their friends. What advice would you have for investors who are thinking about making a real estate investment into a syndication, either using fintech like RealtyMogul is doing or doing it the old-fashioned way through their personal network? What would you say are the characteristics that you find are positive signs?
I've always found, for my own personal investing, I've always found it to be very educational. And one of the great things about investing online is, you can touch it and feel it and visit it. I think that's a nice benefit to real estate, is just, being able to see it and learn what works, what doesn't work, and so on. I think it's a great education.
Okay, great. Why don't we switch gears and let's talk about your REITs for a moment. So what is a REIT and what are RealtyMogul's REITs all about?
So a REIT is a real estate investment trust. We have two REITs within RealtyMogul. Again, everything can be done online. We have one REIT called Mogul REIT 1, which is focused on income. And the other REIT is Mogul REIT 2, which is the focus there is value add multifamily.
So the one that's focused on income, what are you investing in there?
Well, what we try to do there is find light value add multifamily. So these are properties that are throwing off a little bit more cash flow. It may not have quite as much upside, but it's more stable. And we're combining that with some mezzanine debts, some higher yielding mezzanine preferred equity, all to blend to a current return. And Mogul REIT 2 is really pure value add multifamily, whereby the current coupon is quite a bit less because we're doing a much heavier value add there, where we might have to take a lot of units out of commission and we're not getting income from those units. So the current return is a little bit lower, but there's more potential upside in the investment.
So the second one actually owns equity interests in these properties. And the first one, sometimes you own equity interests and sometimes you're making a loan of some sort, like a junior loan on a project. Is that right?
Right. And it's probably the composition of the portfolio now is probably about 60% equity for the and 100% equity for the for Mogul REIT 2.
And how should people decide if they're interested in investing in an individual project or investing into one of these REITs?
Well, the REIT is a cross-collateralized pool. So, there might be some that hit the leather off the ball and are, have really high multiples, and some that, don't work out so well. So it kind of, it's a lot more balanced. It's cross-collateralized, whereby the individual investments are, cross-collateralization could be a blessing and a curse. So if in the individual assets, you're investing just in the one asset. So it's really up to what an investor would prefer.
Do the REITs give investors a chance to redeem their capital out when they're ready, and how does that work?
There is a redemption when an investor will have the ability to redeem their shares, and they go into a queue. We're very proud of the fact that during this last downturn, we did not shut down redemptions. We kept them open. I think we were one of the few non-traded REITs that actually did do that. And that is a risk also, that oftentimes in a non-traded REIT, everybody wants to redeem at the same time, and there are usually protections in the documents to prevent a cash, too much cash moving out of the REIT.
Our series of interviews is all about alternative investments. How would you characterize real estate investments among all the different types of alternative investments out there? What do you think would be realistic expectations of real estate investments like the ones we've been talking about?
I personally believe, and that's one of the reasons why I'm in the industry, is that especially value-add multifamily is a really terrific risk-adjusted return, meaning the return relative to the risk seems like a very good value relative to other investments that are out there. I just think it's a lot of fun. It allows being able to invest online. It allows people to build their own portfolio. We have some investors that have 25 or 30 different investments. It has allowed individual investors to be able to invest in institutional quality assets. And as the business has scaled, we're kind of in this amazing flywheel moment right now where we're able to raise more capital, so we can, the more capital we raise, the more attractive we are to institutional quality sponsors. The better deal that we can market and the better sponsor that we can market, the more institutional investor we can attract. So we're in this really amazing growth period right now, which is really exciting.
If you look out 5 years from now, what do you see in the area that we've been talking about for your company, for our industry? What are some of the things you think we'll see in the next 5 years?
I think that our industry is going to completely disrupt the way things are done now. The private equity closed-end fund model, I think, is going to, as we're starting to compete with these billion-dollar funds, I think that industry will survive in some way, but things are going to look very different. Also, we're just now starting to be able to tap into global markets. FinTech is about 3 or 4 years behind us in Japan. They're fascinated with it. We're trying to figure out a way to, connect. It's a little more complicated because of, SEC rules. There are groups that are using blockchain technology to make that a lot easier. I'm on the board of one of them. The whole industry is going to look very different 5 years from now.
Chris, thank you so much for your time.
My pleasure. Thanks for inviting me.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.